All right, so this should be recording to the cloud. So anyone that jumped into the call should be able to access after the fact. If for some reason you're unable to, you can of course let me know. I'll also be posting this on Facebook, and it will be available within my link tree by tomorrow for access. And if anyone wants me to just send it to them directly over email, I ask that you just let me know in the chat, and I'll make sure it gets over to you. So for those of you that have not done one of these calls with me before, each week I have a topic that I discuss. Typically it's mortgage related, but sometimes it extends into marketing activities, things of that nature. And so for today's call, as promoted, we're going to talk about first-time home buyer programs and down payment assistance. Now, a lot of you, maybe newer agents or maybe agents that have, done a lot of deals and just looking for a refresher. That's the purpose of today, is for us to kind of go over some of the core programs for first-time home buyers, some of the down payment assistance options, and make sure that we're kind of all aligned in kind of what that does for clients and what might benefit them. And hopefully with this information, be able to generate more business for ourselves for year 2026 and ultimately get more families into homes. So I'm going to go ahead and get started with the first slide here. And we are going to talk about all the different things first-time home buyer and down payment assistance. So we've got the first bit of our slides. We'll cover the traditional loan programs, FHA, conventional USDA, VA loans. And then we'll talk about some specific DPA programs that we have access here at North Group Mortgage, powered by Rate. And then we'll talk about some of the state level programs that are out there that you all may not know about that can definitely help your clients get into homes. So that is our agenda. The biggest and the funniest misconception that I hear in this business, especially when I'm talking to a client for the first time, is that they feel like they need 20% to buy a home. That 20 number that everyone gives, it's just that standard number that you hear for people that are casting doubt of whether they can purchase or not. It's always so funny to me because 20% is really a thing of the past. And for anyone that's been in this business for a decade or more, this hasn't been relevant, within that time or even a significant period before that time. This is very much a dated methodology that, an older generation has thought about. And the main reason for that 20% is the fear of PMI. Private mortgage insurance, and what that does to a mortgage, because it's like a fee per se that goes not to benefit you as a client. So a lot of people's parents or grandparents will say, I need 20% to buy a home, and that's just false. There's a million programs out there to get people into homes a lot cheaper. The PMI is not scary, and your average first time buyer puts anywhere from 6 to 7% down. Our job, my specific job as a lender is to go through all the options for a client, but you all are going to be usually the first ones facing a client. And so these objections may be, levied to you. And, hopefully from our PowerPoint today, you all will have some foundation to be able to overcome those objections, and, have some information that you can relate to them before they talk to me. Now, the first of your traditional programs that you all have definitely heard about is an FHA home loan. So I put this in the first-time home buyers programs because an FHA home loan does have a very fair and easy price point or easy down payment minimum that home buyers can get into the market with. It's 3.5%. That's the minimum for a 580 or higher credit score. So for most clients, in that $400,000 range, if they're buying a $400,000 home, most clients that have a 401k, if there's two people on the loan, they're going to have that money, whether it's in their savings or checking or not, irrelevant. A lot of people with 401ks with their businesses and their companies they work for will have the 3.5%. So FHA is very much an easy barrier to entry for first-time home buyers. One of the really cool things with the FHA program is it's incredibly lenient towards clients with credit issues. So I always look at credit in kind of a spectrum. So anything 700 or better, I always call good. 750 or higher, I always say great. Below 700, I call fair until you get to the 600 range, and that's where it starts to deteriorate, right? FHA is great for that fair credit category because it doesn't punish them like a conventional home loan would. Even though conventional loans go down into the 600s, the FHA doesn't really punish them for being in the 600s, either on rate or the mortgage insurance. And the mortgage insurance for an FHA home loan is more or less, or not more or less, it is in fact 100% tied to the loan amount. So as the loan amount increases, so does the mortgage insurance. This is the FHA home loan is best for new buyers with limited savings, lower credit scores, sometimes higher debt to income ratios, for those that don't qualify for conventional financing. Debt to income is one of the pinnacles of how we qualify loans. And for your conventional home loans, we rarely can go above 49.99%. And a lot of times we can't even go that high. But for an FHA home loan, you can theoretically get all the way to around 57%. So sometimes you can squeeze out some more buying power for clients utilizing this program. So again, this is a great tool, low down payment, 3.5% for 580 credit or better. Prices very well for the 600 credit score bracket. Mortgage insurance doesn't change with the lower credit score. It's tied to the loan amount. And so you have that easier barrier to entry. The second of the programs is your conventional 3%. Now, there's a few programs within this 3%. So we'll just talk about the first and foremost. You have your 3% for first-time home buyers. For those of you that don't know, a first-time home buyer is actually just someone who hasn't had a principal residence for the last 3 years. So you could have bought a home 5 years ago, not occupied it, as a principal residence for the last 3 years. You are a first-time home buyer again. So the conventional 3% is exclusive to first-time home buyers on the conventional realm, unless they qualify for HomeReady or Home Possible, which are two income-based programs that if you meet a certain area income limit, it doesn't matter if you're a first-time home buyer or not, you can qualify. Now, the 3% down, on a $400,000 home, I believe is $12,000. Again, a lot of clients who have 401ks, a few years of working, 2 clients on the application are going to have these funds, right? Whether it's in their savings or checking, doesn't matter. 401ks would likely have these funds. So a very easy loan for new buyers or buyers that kind of live paycheck to paycheck to be able to get into with tapping into that resource of something like a retirement account. Now, one of the main benefits of the conventional loan over the FHA is that the mortgage insurance is cheaper, typically. As long as you have a client and what's considered the good credit score bracket, their mortgage insurance is typically going to tier better than an FHA loan. And so when I'm doing my consultations with your clients, I am going through these options with them, so they can kind of see. And, generally speaking, even if the rate for the conventional loan is a little higher than the FHA, a lot of times these loans stack next to each other. The conventional, as long as the credit score is in the good range, is going to be the better option. And for you all, it's going to be better because when you're taking an offer to a listing agent, they don't always love FHA loans because they feel like the appraisals are a little bit more stringent, so on and so forth. And, they don't want, like with an FHA appraisal, the value of that appraisal stays on that property for 6 months. They don't have that with a conventional. So if we can qualify a client for a conventional and it makes sense financially for them to take it, we love this option. Low down payment, lower mortgage insurance. Again, great for good credit score clients. Some of you all may be in markets that have USDA home loans. Some of you may be in markets that have absolutely no access to USDA loans. A USDA loan is a government issued loan with a 0 down payment requirement. So you can do 100% financing. It has geographic and income eligibility restrictions. So if you go to the USDA website, there is a lookup tool to look up the locations. So if you type in a specific address, it'll show you the map if it's USDA eligible or not. And it'll also kind of talk about the income restrictions for this. I hesitate to use the word suburban or rural areas, but I did put that in the slide because some suburban areas in United States do qualify for USDA. It's more of in the past that was more frequent. It's becoming less and less. The idea of USDA loans is to promote rural home ownership. And so you've seen that move away from the cities gradually throughout the years. When I first started in this business back in 2015, there were USDA loans in the Charlotte area. that no longer exist, and you have to push yourself outside of the city limits to find a USDA eligible zone. So these are very specific to the geographic restrictions of the program. But let's say you find a property for a client that is USDA eligible. It is a zero down payment. So that means they're only on the hook for the closing costs. And if you negotiate closing costs, they can be theoretically in for just their deposits, right? So a great first-time home buyer option. It's not exclusive to first-time home buyers. So if you have a client that's a repeat buyer that doesn't want to put a down payment for whatever reason, this is still something that we can look at qualifying them with. VA loans. Now, this one's a bit more restrictive than the other programs that I've shown because it's exclusive to veterans and their surviving spouses. But it is also a zero down payment option, and it has no mortgage insurance, which is one of the main benefits aside from it being a zero down payment option. These are great loans. I absolutely love doing loans for veterans. I think it's one of the easiest loans that people can qualify for. But B, it's very fair to them, gives them a great entry into home ownership without a significant barrier. And as we all know, a lot of veterans, they don't have as much funds as, maybe, regular everyday citizens. And so, being able to get in with zero down payment is a really good option. And another highlight, again, to mention the no mortgage insurance. That is just one of the best perks of this program because, you don't have to worry about that extra fee that can increase the principal, interest, taxes, insurance for that mortgage payment. So now that I've talked about the traditional loans, let's talk about some of the down payment assistance, and let's just specifically talk about stacking. So before I go into the specific down payment assistance loans, with North Group powered by Rate, we've got national down payment assistance programs, which means they are not exclusive to specific states. We do have the state programs and we do work with each state's program, et cetera, but we also have ones that can go cross-border. This is important because not every state program is amazing and not every client loves the restrictions that each state program provide. And sometimes you have clients that are looking at two different states, right? They might be, like in the Charlotte area, it's a border city. So you have clients that look in North and South Carolina. There's a universal program that looks, that doesn't put a little geographical restriction between the two. And so we're going to talk about that. Stacking is very interesting because it means you stack the down payment assistance program with whatever program it can pair with, such as the USDA, FHA, et cetera, to, enhance the benefits for the client. And another thing to mention before we dive into the slides themselves is that these programs that I'm going to show you today, not all of them have income restrictions. And that's a huge because each state program does. So being able to have programs that do not have that exclusivity is really good because sometimes you're going to run into clients that may make a lot of money, but just aren't able to save for whatever reason. It may be a lot of kids, a lot of expenses, taking care of family, sick relatives, so on and so forth. They still deserve home ownership, but they may not have the easiest way of being able to save real money to get to, being able to buy. So the first program we're going to talk about is the Rate Access Down Payment Assistance. So first bullet here, no income limits, guys. This is again, one of the main benefits of these programs is that we don't have the restriction. We also don't require them to be first-time home buyer. You do see this with a lot of the state programs. There's 3.5% and 5% assistance available. So, if a client, needs the down payment only, but has the closing cost, the 3.5% is going to be probably the best bet for them. If they need some closing costs paid for, we'll do 5%. This program is piggybacked off of an FHA home loan. So, the minimum down is that 3.5%. So that's why the 5% is there to help compensate if they don't have full funds available. Now, this is not a forgivable loan. So if they're taking this down payment assistance, it's assistance they have to pay back. So this is not one of those forgivable programs. We do have some forgivable programs, but this is not one of them. So they will pay it back. It will be part of their monthly payment. And we walk them through what that looks like when we're doing the strategy meeting, when we're going through their numbers. The big thing for them for this program and the clients that this is going to be best for is clients that have no other options, right? They need down payment assistance to buy a home. They don't have the ability to qualify for a state program. They don't have the ability to qualify for a program that may has a forgivable loan. They need this loan. This is the only way of home ownership. This is the loan program I'm going to take them to. Another program that we have is called our EquityAid program. So this is a little bit more state-backed structured, meaning it's more similar to your housing finance agency type transactions, which means it has more competitive rates, better terms. You can do 3.5% and 5%, just like with the AccessDPA. But this is also paired with USDA loans. So it's not just the FHA like the Access. There is both forgivable and non-forgivable options. So for clients that don't want to have that monthly payment, where they have the non-forgivable, they can do the forgivable options and we can walk them through what that looks like. But going back to the mention of the USDA loan, really cool. You can have a program, USDA, which is zero down payment, and a client take 3.5% assistance to cover all of their closing costs. Really good stuff for clients that can't get closing credits, don't have money for that, and still want to obtain home ownership. And again, the stacking part is really cool. I probably do 3 or 4 loans a year where the clients have no money due out of pocket, and it's through the stacking method. Another program which has kind of come into the light over the last couple of years is the Fannie Mae, Freddie Mac grants. We call it the OneDown program. So the way that it works is the buyer brings quote unquote 1% of the purchase price of their own funds, and then Rate contributes 2% lender paid grant towards their down payment. But the caveat is it's up to 4,000. So it's whatever the lower of 2,000 or 4,000 or 2% or 4,000 is. So it's not always going to be an actual 2%. The Fannie Mae or HomeReady or Fannie Mae or Freddie Mac programs will add an additional $2,500 to this. And that can theoretically bring the combination of funds up to $6,500. But this is a conventional product, right? So a lot of the programs I just showed you was FHA or FHA and USDA. This is a conventional loan. Some clients are going to prefer this because they have good credit. They don't want the FHA mortgage insurance premium. You might prefer this because it might be easier to get offers accepted, so on and so forth. This program is out there for clients to take advantage of, and it does provide good assistance here. It's just not as easy to fully understand because we have some caps in some various areas. I do like this program. I just don't like how I have to kind of tier and explain it. But it's there, it's real money, it's not repayable. Clients get that money. And for clients that don't necessarily need the money, they can use that for a buy down. So if any of y'all have heard about, temporary or regular buy downs, it's a way to reduce your interest rate either permanently or temporarily, and clients can use these funds to achieve that. So for those that are, rate sensitive or monthly payment sensitive, this can be a way to help them, even if they didn't need the assistance on the down payment or closing costs, just help them have better terms. And so that's where we're really looking at the value from this, as a lot of clients are seeing more value from that than the actual sum total of the grant, because it's not maybe as much as you would see from some of the other programs. So in North Carolina, we have the NC Housing Finance Agency. This is an awesome program. I've worked with it since 2015. I've closed probably, let's say, 5 to 10% of my business every year directly through this one program. Clients love it. And one of the real cool things is they have 2 different programs. So they have the Home Advantage Mortgage and the NC First Home Advantage DPA. The Home Advantage Mortgage has a much higher income restriction, typically in the 150K range. It is county specific. So some counties are going to have lower, some counties are going to have more. But they'll provide assistance up to 3%. It used to be 5, but right now it's at 3. And that is money that just goes straight to the deal, and the client can apply that to down payment or closing costs or both. This is forgivable after a certain period of time. With North Carolina, they have extended that to 15 years. Now, at year 10, it declines 20% in balance. So the down payment that they gave you, the 3%, declines 20% each year until year 15, where it's at zero. So technically, it starts to decline after 10 years, but it's fully forgiven at 15 years. It used to be 5 way back in the day. That was obviously a lot better, but when they beefed up their program to keep up with, the rising housing costs, they did, provide that caveat. The first home advantage DPA is one that I see is much more popular with clients because it's a blanket 15,000. A lot of times this is more than the 3%. And so there's money left over for them to pay some of their closing costs. This can be stacked. Both of these programs can be stacked: conventional, FHA, USDA, or VA. So for those programs like USDA and VA that have no down payment requirement at all, this money can be used to reduce their loan to value, i.e., give them a better equity position, or just cover all of their closing costs and then also reduce with whatever's left over. This is still forgivable over 15 years. So it has the same requirement as the Home Advantage program. But I do not see a lot of pushback from clients on that. It may sound like a very strict requirement, but a lot of clients look at it as, if I do sell or refinance the home before that year 15, it's just me deferring when I paid that 15K, right? Either I pay it at closing when I don't have any money, or when I buy the home, or I pay it when I sell the home when I do have money because I have equity. So that's how a lot of clients have looked at it. Both of these programs do have income and purchase limits. So it's very important. These numbers change every year. It's very important that we talk very carefully with the clients and yourselves about what the max will be with these programs. Because they are state regulated, they do come out with their own guidance. And if we don't adhere to it, we can't do their loans. So we have to make sure we do that. I know some of you are in South Carolina, and some of you are in Georgia, and maybe even Florida. All of these states have their own programs, right? Not just North Carolina. I'm using this one as a particular example for today, but each state has their own various programs. Some are good, some are not good. But at the end of the day, every state has a program, not just the national ones I've shown you. If you're curious about your state's program, you can typically type in your state housing finance agency somewhere along those lines on Google, and that'll take you to the website, and you can go through. And of course, you can always call me directly and we can talk through everything together. Now, I created this quick reference guide for like which program kind of fits which buyer. FHA, minimum down payment 3.5%. Typically, you're going to want to put your clients that are 580 credit or better with this program. We do go down to 500, but with a lot of stipulations. So that's why I didn't put that. Conventional 3% down payment, minimum credit, caveat 620, but not really. They just changed that guideline over the last couple months as far as, is there a credit limit, and there's no longer one for conventional. But generally speaking, you're going to want your clients to be 700, like I said, best for over here or higher. There is no income limit specifically for the 3% program unless they take advantage of the HomeReady, Home Possible programs, which have some better rates, better mortgage insurance, or for repeat clients that are not first-time home buyers, if they qualify, can take advantage of that first-time home buyer benefit. So I put an asterisk on that. USDA is 0% down, minimum credit 620. There is area limits, rural/suburban, limited savings is its best for. VA also 0%. Credit is flexible, so theoretically you can qualify anyone for a VA home loan despite credit hits or whatever. But there has to be significant compensating factors if you're below a normal credit score range. There is no income limit for this, so you can make $5 million a year as a veteran and still use the program. Veterans and active duty are the best for, and surviving spouses that qualify. And again, we talked about these various DPA programs. Each has their best for needs and minimum credit requirements. So I know I said a lot, and I'm more than happy to go back into different slides, but I wanted to open the floor to questions and answers. I know the DPA and the first time home buyer programs seem relatively straightforward, but I know that there's a lot of nuances. So I wanted to give you guys that floor. All right, someone's got to have a question.
I had a question.
Perfect.
So for the down payment assistance, what is the minimum credit they should get?
I usually advise clients that there's not necessarily a minimum credit, but ideally you're going to want to have a 640. And here's why.
Mhm.
For down payment assistance, the most access to the programs will be at 640. There's programs that will go below that, but the state programs a lot of times will be at the 640. And so if you have that, then you have access to all the programs. So then it's just about what makes the most sense for your specific needs, right? So I usually target 640, but that's not the minimum. The minimum, let's just call it 580.
Thank you. And a 580, you said it's limited. Um, they won't, is, would they qualify for the 3%?
3% on the conventional. Technically speaking, with the new guidance that we got this year for credit for conventional, technically, yes, they can. However, the automated underwriting for the conventional program is likely not going to accept anyone in that credit score range. They're probably going to be a better fit for the FHA home loan at 3.5%. And that's something that I would go through with your clients when we're screening everything and working through the pre-approval.
Thank you.
Mm-hmm. Anyone else have any questions? Michelle, I see your message here on the sending the presentation over. I will definitely send that to everyone. Let's see. Is there another message now? Okay. Well, if there's no other messages, I will give everyone back their time. I do appreciate everyone once again jumping on the call. I have not decided my topic for next week, but if any of y'all have something that you would like to see for next week, I typically decide that by Thursday. And then I put out my newsletter on Friday that specifies what that will be. So if any of y'all want to have an influence on that, more than happy to take suggestions. I've done some cool ones in the past on AI and all that. And matter of fact, for those that were on that call that are part of today's, you'll recognize that my slides are made from Claude. And the slide deck that you all went through today probably took me 3 minutes to make, with a little bit of input from myself. So if any of y'all are curious about that type of stuff, reach out to me. More than happy to share those details, share the slide deck from that call, and help with that education. But I do appreciate everyone jumping on today, and I wish you all the best for your Tuesday.
Thank you. You too.
Thank you so much.
Of course. Bye bye.